Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview and global market update right here from the heart of the financial district in central London and the studios of Core TV. I'm Martin Bakkerdax, London Bureau Chief here at TheStreet.com. I'm going to take you through those 5 things you need to know before the bell on the last day of August and the day before the next most important economic data release of our lifetimes, at least for the moment. Friday payrolls, of course, but lots happening prior to that. We'll get right to it with European markets because we're looking very strong, indeed about 0.5% gains across the board, and actually a very solid bullish sentiment for global equity markets. Part of the reason why, of course, is the data that we saw yesterday out of the United States. We had a better than expected reading in private sector job creation from ADP, as well as a very strong upward revision for second quarter GDP growth from the Commerce Department. We hit 3% for the first time since Trump's presidency, a figure that a lot of people scorned and ridiculed and said certainly wasn't achievable. Difficult to say whether it's going to last into the third and fourth quarter. It probably won't, but nonetheless, the fact that we did hit that 3% threshold was enough to lift the dollar about 1.5% against a basket of its global peers. That kept regional stocks around the world on the back foot, and that's part of the reason why we're seeing equity gains. The yen traded at a 2-week low against the US dollar. That lifted the Nikkei about 0.7% into the close today. And we're looking at a softer euro as well and a softer pound sterling, and those are helping support equity gains around our region. There was also an inflation reading for the month of August from Eurostat, which is the official statistics office here in Europe, and they said the consumer prices accelerated at a 1.5% annual clip. That's a little bit faster than last month, but still some distance from the European Central Bank's just below 2% target. So it didn't really move the euro that much, and actually when investors looked in underneath and saw core consumer prices, which strip out food, energy, alcohol, and tobacco prices, well, they were unchanged from the month of July, and they're only rising at a 1.2% annual clip, and that's a long way from the just below 2% target. So the euro wasn't able to find any favor as a result of that, and that was actually decent news for European stocks. The retail sector's on the back foot, and I'll tell you why in a couple of minutes, but nonetheless, more broadly, the economic sentiment is good around the world. I mentioned those data figures yesterday in the United States, but also official figures from China showed the manufacturing sector and the broader economic benchmark of activity rising a bit more than expected in August. Now, you remember China is the second biggest economy in the world and one of the fastest growing. It advanced at a 6.9% clip in the first 6 months of the year, and it looks to maybe top that in the second half if the numbers we're seeing are persistent going into the fall. That said, the construction sector numbers weren't exactly great. They were a little bit softer than anticipated, so there are some questions as to whether the growth momentum can be maintained. But nonetheless, China's looking good, the United States is looking solid, and when you have the world's 2 biggest economies on an upward trajectory, well, that's only going to benefit equity markets, and that's exactly what we're seeing today. Going to move on and talk about Carrefour because that is the reason that the retail food space and retailers in general in Europe are on the back foot. Carrefour is a very interesting stock here in Europe, and it's a company that we should all be paying attention to. It's the number 2 retailer in the world, and it's effectively Europe's Walmart. It is selling everything from furniture to clothes to flat screen TVs to food. It's a behemoth in the French market and one of the most influential retailers in the whole of Europe. Their shares are down the most on record today. They fell 15% at one stage after the company gave us a surprise profit warning for the second half of the year, slashed its second half sales forecasts, and said it's got to improve margins as a result of the difficulty it's having passing on price increases to ever recalcitrant customers. Now, a lot of people are saying as well that the fact that Carrefour is performing so poorly this year, it's down 35% year to date, is the fact that its online offering simply isn't up to snuff and is actually losing market share to people like Amazon and others. But this is no small company. I mean, you are looking at first half sales for Carrefour in the region of 45 billion euros. So that's somewhere in the region of about 50 billion US dollars. Now, they missed on the first half numbers as well, and of course trimming the second half guidance didn't help the stock, and that's why we saw the record fall today. They've got a new CEO in place as well, who actually comes from a group called Finac, which I suppose, if you were to describe it in American terms, would be similar to somebody like Best Buy, although they also sell books and records and tapes and CDs and things like that. But the reason I mention that is because Finac has a very aggressive online strategy, and that's part of the reason that it has been able to hold up its sales growth. So hopefully that can be overlaid into the business model in Carrefour, and they can steady the ship a little bit. But nonetheless, the whole of the retail space is on the back foot today as a result of the Carrefour profit warning. And of course, I simply think just the extension of the impact of that Amazon purchase of Whole Foods back in June, the price cuts that we saw earlier this week at Whole Foods, and of course the ever increasing price pressures that we're seeing in food retailers all around the world. And of course, this really just explains why we're seeing activist shareholders heading to some of the big food producers like Unilever, like Nestle and others, and saying, you guys got to improve margins because you're simply not generating the profits that we demand in a rising equity market that we're seeing. So this is a story that has a whole host of dimensions. We're going to be paying particular attention to it in the days and weeks ahead. Please come back to TheStreet.com for all the information, because this one has implications not only for Europe, but for the United States as well. We move on and talk about Toshiba. This is a story that simply won't go away, and it has to be said, part of the reason it won't is Toshiba's own fault. It missed its own self-imposed deadline today to sell its prized memory chip unit to one of its preferred consortium bidders. Now, there are 3 groups out there that want to get the unit, and the flash memory unit makes chips that we put into cell phones, into tablets, and into all sorts of smart devices that connect to the Internet of Things. So it's incredibly valuable because it's number 2 in the world, just behind Samsung, and it is worth, on some estimates, anywhere between 18 and 20 billion US dollars. Now, why is Toshiba selling it, you ask? Excellent question. Toshiba, at its peak of expansion, was involved in all sorts of activities all around the world, including atomic energy development in the United States. Westinghouse, the unit that it owned and bought from a couple of years ago, filed for Chapter 11 bankruptcy protection earlier this year, and the liabilities as a result of that were much larger than expected, and perhaps somewhere in the region of 11 to 13 billion US dollars. So Toshiba needs to raise cash in order to meet those liabilities, and the best asset they have to get rid of is the flash memory unit. All sorts of people looking at it. Western Digital is one company. Apple potentially could be another, along with Bain Capital, in a group that would involve also a company from South Korea called Hynix. Now, that would be a great purchase for the 3 of them, because in some respects that would allow the chip supply chain to remain steady into Apple, and it would also give them a stake in a company that makes, obviously, a very key component for some of its iPhones and tablets. However, there are some concerns from the Japanese government's perspective as to whether or not such a critical component to the country's economy should be sold to a foreign bidder. And that's part of the reason why that Western Digital has been in the front line for this, because it's wrapped up with a Japanese government-backed investment fund in order to try to build and come out as the winner in this bidding war for the flash memory unit. Western Digital has also been in partnership with Toshiba in the past and has used the courts to put pressure on the company to make sure that Western Digital gets the right of first refusal to any potential sale. So there are many machinations that are still ongoing and need to take place in the months ahead before Toshiba can actually get rid of this asset and fill that hole that is growing every day as a result of the Westinghouse bankruptcy. But there's one more time pressure we need to pay attention to. Toshiba's already been relegated from the Nikkei 225 as a result of its failure to file timely disclosures for full-year earnings. If they file 2 consecutive years of negative net worth, they've already done 1, and the second will have to be filed by March 2018, they will be kicked off of the Tokyo Stock Exchange altogether. That will have major implications for its ability to raise funds and, of course, its credit rating and, indeed, its overall balance sheet. So this is something that they need to address. They need to address it in the next few months, but the fact that there's so many people willing to pay an ever higher price for the unit has some suggesting maybe Toshiba shouldn't sell it at all. Okay, we're going to move on to the biggest story in the United States today, and that is the human and the economic devastation that we're seeing in and around the Houston region as a result of Hurricane Harvey. It's been downgraded to a tropical depression. It was a tropical storm for the last couple of days, but nonetheless, it's dropped about 50 inches of rain in and around the region and has wreaked havoc all over the city of Houston and some of the satellite suburbs of what has to be said and has to be remembered is America's 4th largest city. Now, from what we understand at the moment, the death toll has risen to about 35 people, which is absolutely astonishing in the region when you consider the devastation that we're looking at, and about 32,000 displaced. Estimates from the Red Cross suggest that as many as 500,000 people in the region are likely going to need federal assistance. Now, this is going to put some pressure on the federal government. Congress is going to have to pass an aid package in the next couple of days to make sure that the cash is going to reach those in need. You'll remember that Katrina cost about $110 billion in federal aid, and Hurricane Sandy in 2012 cost around $54 billion. So Congress is going to have to pass a significant increase with respect to that if the estimates of damage, which we're seeing, and they run anywhere from about $8 billion to $50 billion, are indeed accurate. Now, this comes at a time, of course, that Congress is debating whether or not to lift the debt ceiling, and that is a clock ticking event that is probably going to come good at the end of September. So there are political implications to Congress passing the aid package that is going to be needed for the people of Houston, but I can't possibly imagine that a debt ceiling debate is going to slow federal aid to those people in need, particularly when you're looking at the catastrophe that we're seeing at the moment. So I do suspect that'll get passed, but we don't know exactly what kind of money is going to reach those in need just yet. From a tangential point of view, we are seeing gas prices rise as well. Gasoline futures actually traded at $2 a gallon for the first time since January 2015 in early Asia dealing, and that's going to be increasing prices at the pump. Gas Buddy says that average prices now are $2.45 a gallon across the United States. That's up about 10 cents from the same period last week and up about 21 cents from the same period last year. But we are looking at gasoline futures prices having risen around 23% since the hurricane made landfall in the 26th, I believe, of August. So the fact that we've seen gasoline futures rise to that degree probably suggests we have another 20 to 30 cents a gallon to go on the rise for prices at the pump in the United States. But as we've mentioned before, the fact that crude inventories are rising because the drillers were largely out of the path of the hurricane means that gas prices will probably tumble quickly once the supply chain is sorted out. But it has to be said, some of the biggest pipelines are shut down as a result of the flooding, and there was an explosion in the suburban city of Crosby, Texas, just to the northeast of Houston overnight, of a chemical factory, and that has led to an evacuation and just further illustrates the difficulty that authorities are having keeping a lid on the damage and actually preventing more industrial chaos, the likes of which we saw early this morning in Crosby. Okay, we'll move on to Wall Street. Dow Jones is called about 50 points to the upside right now, according to futures prices, and we might get similar but slightly higher gains for the S&P 500 and indeed the NASDAQ. There's a decent amount of earnings today. Campbell Soup, Dollar General, and Lululemon are three companies that are going to give us quarterly earnings. And we're also going to take a look at Disney. Walt Disney Company stock is trading pretty much flat in pre-market, but there are reports out there that the company is looking at further job cuts in its ABC unit. You'll remember that Disney shed a whole host of on-air talent at its ESPN unit earlier this year in a cost-cutting effort, and it looks like they're going to do the same at ABC. These are just reports at the moment. They haven't been confirmed, but we'll watch that with interest. And of course, investors are going to be wondering what kind of market impact Donald Trump's plans to reform the U.S. tax code are going to have. He, of course, made a speech last night where he tried to outline some of his larger ambitions. It was relatively short on detail, it has to be said, but I think the president would like to use some of his political capital at the moment, gained from the fact that he's been very disciplined and very on message this week, both with the North Korea crisis and the floods and the devastation in Houston. And if he can use that discipline to gather some political capital for some tax reform at the same time that he's trying to get budgets passed and a debt ceiling lift, well, he might just be able to do it. Markets are relatively bullish with respect to that, but he still has a long way to go, and there are a lot of wildfires in and around his plans, certainly linked to the ongoing investigations into campaign ties to Russia and a whole host of other business activities as well. So we can never discount the fact that headline risk is going to trip up the president with respect to his larger ambitions, but nonetheless, he does seem to have some momentum with respect to tax reform, and we'll see if that can carry through the rest of the day. Well, that's here from us. That is it from us here in central London, M5 before the bell. I'm Martin Bakkerdax, London Bureau Chief here at TheStreet.com. Thanks for watching, and we'll see you tomorrow.